Hello, my friends. Let's say you want to get started with the investment thing. So you have some money saved, but not enough to buy a big house or a big car, but still you want to start with the investment. You've heard your friends meeting in parties that they've invested in Tesla, Amazon, Google, Microsoft, and you're sitting there just scratching your head. You know investment makes sense, just that you don't know where to get started. If that's your story, then you are me just about 8 years back when I was still dabbling and trying to understand where should I get started from, what should as a beginner I understand how daunting the stock market story looks like, where to buy, what to buy, how to analyze a stock, when to get out of that, when to sell that. So the whole thing is very overwhelming and very daunting. And I've been there. Trust me, I know how it feels, and I know how helpless you feel. You want to get started, but don't know where to get started. So in this video, guys, I'm going to break it down in a very easy form for you to make sure that all of you start investing. Of course, do your own research, do your own study, but this video will be enough for getting you started. So do watch till the end, because towards the end, I share some exceptionally good tips which will help you get started. So without further ado, let's get. So with that in mind, treat this video as your ultimate guide to investing. It's a kind of video that I hope I would have found 8 years back when I was starting my investment journey. You know that by default, money loses its power year over year, thanks to something called inflation. In US, the inflation stands in general about 2 to 3% per year, which means that your stuff becomes expensive or loses its purchase, or your money loses its purchase power by 2 to 3% year over year. So let's say that a cup of coffee in 1970 was costing us about 75 cents, which in 2019 was about $1.59. So just to understand that, let's say that you have about $10,000, and instead of investing anywhere, you just put that money under your mattress or under your pillow and just forget about it for 10 years. Now, after 10 years, your same 10,000 do not hold the same purchasing power that held about 10 years back. What is that? This is inflation in action, which means money that is not invested loses its purchase power with time due to inflation. So the only way to stay ahead of the curve is by investing your money in the assets that are making you money to the rate that beats inflation. So that brings us to the next logical question. How do we stop our money from losing its purchasing power? So think about it. In this case, right, it's 2 to 3% inflation. Let's say you had a hypothetical saving account which was also paying you about the similar range, about 2 to 3%, which means things are getting expensive by 2 to 3%. At the same time, your bank is giving you 2 to 3% as well, which means you are matching, which means you are neither growing your money nor you're losing money. You are matching that power. And in case you want to grow your money and not just match inflation, that's when you talk about investing in the accounts that give you more interest rate than just to beat inflation. And that's where investing comes into play. So now we agree that we do not just want to not lose the money, but in fact we want to grow the money. We want to earn the money. That's the case wherein we need to find an account which pays us more than the inflation. Let's say we talk about 10% year over year, right? So 10% may sound like a very small percentage, but guys, if you extrapolate that over a long period of time and let compounding play its role, you will be amazed at how much big a corpus will become even with small investments year over year, getting just a 10% rate of return. And that's where investment comes into play, and that's where you have to open an investment account and let your money work for you. Guys, if you're getting any value out of this video, please consider liking, subscribing, and sharing with your network of family and friends. Guys, I can't emphasize more on the power of compounding. There's another video of mine which you must watch if you want to understand the power of compounding, and I'll post that into the links, and here's for you to watch as well. Now the $100, let's say in our example that we invested in the year 1, in the year 2 with the 10% interest rate becomes 110, in the year 3, 121, and in 10 years time it becomes 236 without me doing much about it. It is just that I have parked my money in an investment account which is just earning 10% year over year. So you just have to invest your money there and sit quietly and enjoy the magic of compounding. Given enough years, time does rest of the magic. So there is no hypothetical savings account that's going to give you 10%. So what you could consider is opening a brokerage account and starting your investments from there. That brings us to the next point. What is an investment? Investment is something that beats inflation and rather puts money into your pocket. So talking about investments, let's start with the housing example, because I think that's what most of you will be able to relate with. So when I buy a house as an investment, right, I have two ways to make money on that. One is through the rental income, the other one is through the equity gain, which means the housing price rising over time. So let's say that I buy a house which is worth 100,000 US dollars today, and then I rent it out for about $830 per month, which means $10,000 I earn out of it per year, which is 10% of my initial 100,000 invested, which means that if it is rented, everything else remaining same, rented for the same $830 per month, in 10 years I would cover up all my initial investment. At 10% I earn back 100,000 in 10 years. Plus, there would have been some equity gain over that money of initial 100,000, because in developed countries like US, we've seen historically that the property prices about tend to double in about 10 years. So 10 years down the line, I've already acquired all the initial investment through my rental income, plus I have gained another $100,000 in equity. So it's a very good investment. But let's say we don't have that much of corpus to invest in a house, or we don't want to get into the mortgage details, or don't want to tie up with a rental company. If there could be a better way wherein we could start parking our small amount of corpus into something that still puts us in the investment game, but not taking all this effort that is needed in housing investment, that's where stock market investment comes into play. So talking about me, most of my investment is through stock market. Either that's shares or it is mostly index funds, ETFs, all those things. Because personally speaking, I prefer that over real estate investing. And I know this could raise a lot of brows, but that's a personal choice, because I love the liquidity of the share market, that today I buy something and tomorrow I need that money for my purpose. I could just, on a click, I could sell that and come out of that investment, which is something that real estate market does not offer. You have to put your house on market, and depending upon how the market is that time, up, down, it may take some time for you to get out of that investment, plus the cost of dealing with the realtor and things like that. So personally speaking, for me, I love stock market investing, and I'll say that about 80 to 90% of my investment is in stock market because of the flexibility that it offers and the liquidity that offers. So that brings me to the next and the fifth point. What are shares and how do we invest in that? So shares are a part of a company, which means you own that company to the extent that you own that company's shares. So that's how you invest in a company, and the company works hard to take up the share value, and that's how you grow in your wealth. So let's take an example of Apple and Microsoft. By the way, both are very good tech companies. Apple has a very profitable year this year, and they decide to give $1 million as a dividend to all their shareholders, all the owners. So this $1 million gets divided among all the shareholders to the extent that they own shares of Apple in their account. So let's say that you own 1% of Apple shares, right? In that case, this 1% of 1 million will go to you because you have the ownership to that extent. So that's highly unlikely, because if that would be the case, you would be a super rich person. So that's one way of earning the money, that's through dividend. Dividend is the profit that a company shares with its shareholders. Another way of earning through stock market is the long-term capital gain, which means similar to the example of the housing that I shared a few minutes back. You earn the capital gain over long-term value. Let's say you bought Apple at a share price of, let's say, $50, and now it is sitting at $200, right? So that's the capital gain that you've earned just by holding Apple share for a longer period of time. And once again, guys, if you have not subscribed to my channel, please consider subscribing and liking and sharing with your network of family and friends, so that I can keep bringing in this wonderful content for you. And let me know in the comments below that what else would you like to learn in this journey of investment. So just to explain what capital gain is, let's say that I buy 100 shares of Apple in year 2019. Now the cost of Apple share that time was $51 per share. So calculating that, I invested about $5,100 in Apple share, and let's say in 2024, at the time right now when I'm recording this video, the cost of Apple share is $221. So the same 100 shares today at a cost of $221 per share gives me $22,100. So difference between $22,100 and $5,100, which is $17,000, is my capital gain. So you see how easy it is to invest your money. Just by investing $5,100 in a good company stock and waiting there for 5 years, that $5,100 just gave me a profit of $17,000. So you see how simple and straightforward investing is. So by now, you'll be having a lot of questions in your mind that how do you get started and how much money do you need to get started? And we'll come to that. So to start investing in stock market, we need to have an account with a brokerage firm. So there were times when there used to be a physical broker that to buy a stock you have to call that person up and ask them to place this trade on your behalf, and they'll charge you and things like that. But no more things like that. Even when I came to US 9 years back and when I started investing, there used to be a cost on every trade. So let's say I'm buying X number of Apple shares or Microsoft shares or even selling them, right? Every buy and every sell had a $7 cost, if I remember right. So unless you make a profit of more than $14, there is no point of even getting into that trade, right? Because you're losing money. But over time, I have seen that companies have moved away from charging, and almost all the companies nowadays do not charge you for placing these trades. Having said that, now coming to the initial point that you need to decide which brokerage house you want to go ahead. For me, it has always been Fidelity, main for the reason of consolidation, that all my accounts are in Fidelity. But you could choose Fidelity, Vanguard, Charles Schwab, anyone. All of them are equally good. So it's that simple. Just open your account with a brokerage firm, link your checking account with that so that it's easy for you to transfer the money, and then you are good to start. Now that we're all set with a brokerage account, a checking account, both of them connected, and we have some money to get invested, what to do next? Which company to buy? How much to buy? When to buy? Guys, this is a very tricky question, and I always say and I always believe that running after individual stock is a loser's game, because a stock might be doing very good today. Look at GE where it was 15-20 years back, and look at that stock now. So many, there are many cases where the stock looks very promising when you look at 1, 2, 3, 5 years return, but you don't know what the future of that stock could be, because the price of the stock is dependent on many factors that are outside of our control. So I have found, and I really believe in this foolproof method of buying index funds or ETFs. And I have some very good videos made on that, so please check this one out, why we should be buying index funds or ETFs, right? Theories on that, and there's a lot of knowledge available in case you want to educate yourself. But just cutting it short, I prefer buying index funds or good quality ETFs. Index has a self-cleansing process built inside that, so that if some companies are not performing good today, tomorrow they'll be taken out and be replaced by another performing company, right? So at the end of the day, you as an investor, for you it's a very passive investing strategy. You are not spending a lot of time researching which stock to buy, how much to buy, what is the price to get in, what is the price get out, none of those things. So you focus on your full-time job and let the indexing do the investing part of you. Not say risk-free, but that is low risk, and then it has a consistent growth track record of 10 to 12% year over year. Even the investor guru Warren Buffett believes that the average US investor should regularly be putting their money into S&P 500 index fund, because for him also it's the easiest long-term investment strategy for most of the people. So now that we've touched upon index fund, let's just understand what the hell is index fund. So let's break it down. Index fund is a combination of fund and index. So let's see, what is a fund? Fund is a combination of stocks, right? So let's say that you have heard about mutual funds, things like that. So let's say it's a fund, it's an actively managed fund, and I'm a fund manager, and I decide that I'm going to have these 10, 15, 20 companies in my fund with some respective weights. So Apple may have a weight of 3%, Microsoft 5%, some other company XYZ%, and everything put together, all these shares put together, the total weight is 100%. I'm a fund manager, and you are paying me 1 to 2% of management fee to maintain this fund, to make sure that you are making money. But it's my job to move some stocks out, move some stocks in, to actively manage the fund to make sure that you're making the money, right? This is called a fund. We'll talk about what an index is, right? So for example, you have S&P index here in US, S&P 500 index, which consists of top 500 companies. And then you have other indexes like Dow Jones Industrial Average Index. So for example, to understand S&P 500, that host top 500 companies in US. Now this is the breakdown of that index. Microsoft, Apple, Nvidia, all these companies. So as we have seen that there are different companies, top US 500 companies in S&P 500 index. You start with Microsoft, Apple, Nvidia, and these are the percentage of these companies in this index. So 7.38 is Microsoft's holding here, then 6.86 is Apple, Nvidia 6.52, and as you come down, so a lot of these companies must be very familiar to you. And as we come down, you have Cisco, Accenture, Intuit, Abbott, Intel, and then Citigroup. And then as you come down here, right, as you move towards the bottom of the list, there'll be a lot of companies which you may not have heard about, right? Davita, and then Globe Life, FMC. So total 503 companies, right? This is what comprises of S&P 500 index. And If you look at the performance of S&P 500 for the last year, it had 26.2% return. Last five years, 16.4%, and total return is cumulative return is this much. So you see, year over year, S&P index or any good big index for that matter performs very good. So if you look at the performance of S&P 500 for the last 5 years alone, you see we started at 2990 and we are sitting right now, as I'm making this video, is 5537, which is an 85% growth in about 5 years, which is very, very good given it's an index. And given if you invest in any S&P 500 index, then you don't have to stay on top of it, buying, when to buy, when to sell, how much to invest. Whatever money you are investing, that money is growing on this rate over a 5-year period. So it's a very passive form of investing and short form of investing, given that in the long run, the US economy is going to make money. You're not investing your money for 6 months or 1 year, you're investing it over a long horizon. So you would see that if you pick up a long period, the market is going to give that money back to you with multiple times more returns. So guys, let's come back to S&P 500 index once again and let's understand what is happening here, right? This graph takes me back 1996 and then we are looking at 2024 right now. So overall in this time period, we had about 639.55% growth, which is commendable. The main benefit of an index is that we are looking at a long-term horizon when we are investing our money. So as you see, there have been multiple downfalls here. 2002 is when we see a dip, and then 2008, 2009 financial crisis. Then we had seen a COVID in 2020, and then we have entire global landscape changing in 22, 23 with all that's going on in the world right now. Despite of all that, if you observe, the long-term trend is the upward trend in this index. So guys, if you're going to invest in any good index fund, for example, anything that is replicating S&P 500 or even the US total market stock exchange, the idea behind an upward movement in long term is that overall, given enough years, the US stock market is going to perform and it is going to put a lot of money back into your pocket. All that you need to do is be consistent with your investments, stay put, do not buy, do not keep selling, do not, just once you buy it, consistently buy and just stay put, invest it and forget it and let the time do its magic, let the power of compounding kick in and you will see the magic that if you do not disturb it and you consistently keep buying the index funds with certain amount every periodic cycle, you will see so much money being put back into your pocket. And this is the benefit of index investing. So as I've mentioned earlier in this video also, that most of my investment is in any of these index funds, be it total market fund, S&P 500, or there are different funds, there are dividend funds, there are growth funds. The idea is that I want a pure passive investment because I'm in a full-time job and I don't have time to research stocks and then, go back and think about it, whether I bought it the right price, wrong price. No, I don't want to do that. I don't have that liberty of time. Plus, I want to invest my money. I'm an investor and I want to see my money grow. So the best part for me is find out a good index fund, park your money there every 15 days. Whenever I get my paycheck, I have a set amount that gets invested in these index funds without me disturbing anything. That's the benefit of index fund. You can put that as a standing instruction. And plus, other than that, there is very low expense ratio. If you look at these good index funds, the expense ratio is very low, which means that you are not paying somebody a very high management fee only to manage that fund. These are passively managed funds, so you don't have to pay a lot to anybody. That's pretty much it, the passivity of that index fund, the low expense ratio, which means my maintenance cost is very low. Plus, me putting a standing instruction to be buying these stocks every 15 days, buying these index funds every 15 days, that's a game changer for me. I don't have to spend hours researching on the stocks and still I am very much invested in the stock market. In fact, Warren Buffett famously says that if you were to give him $10,000 today and ask him to invest in any stock, he would nicely buy a S&P 500 index fund and just rest his case there. Results have shown historical that it's very difficult to beat the market with an actively managed fund, which is where the index comes to your help, So there's no reason to run after the next Microsoft, next Apple, next Nvidia. There's no reason to do that, right? Let's not run after each of these individual companies and invest as an index as a whole, which means we are gambling on the entire US stock market. And history has proven that given long term, the US market is going to perform and it is going to put money in your pocket. So now that we're sorted on the index fund investing, comes the next question, which is, isn't stock market investing risky? Guys, the answer is a beautiful yes and no both. Now, depending on which side of coin are you looking at. See, I grew up in a household wherein my mom and dad kept telling me that one of my uncles invested in so and so company and he lost all his money, and the other one invested in another company, lost his money. So I grew up hearing these horrifying stories of stock market investment that I had no interest of investing until I came a point wherein I moved to US and I decided to educate myself. I read a lot and I implemented a lot, and I thought, let's get started. Let's stop believing those stories and test for ourselves. So think about it, guys. In which case would you lose your money? So let's say this is a case of a Microsoft stock, right? So let's say I bought a stock when it is about 413, or let's say I bought a stock when it was at this high, $427, right? And I'm like very delighted about it. I bought a Microsoft stock and I'm going to make profit. This is April 11th. Now let's say that after that there was a news in the market because of which the stock is going down. There's a downward trend, right? And at this point, when it is 389, it's high time. I cannot sustain anymore, and I believe that I've invested in a wrong company, and I don't believe in the fundamentals of Microsoft, and I decide to sell my stock. Now, when I sell the stock at this point, when it is at a low of 389, then what I lose is the difference between my buying price of 427 and my selling price of 389. Now understand this, if I trust the fundamentals of this company and I would have just stayed on it little longer, then I would have seen the growth, and the growth again goes like this. And then today that stock of Microsoft, which I bought at 427, now it's standing at 460 today as we are making this video. So guys, the idea behind this is that we lose the money only when we sell the security. So you just have to stay put. And I understand it is difficult to stay put when you talk about the individual stocks, because you don't know what is happening within that company. You don't know what the management decision is. You don't know whether that company is going to invest in AI or it is not going to invest in AI, or what is going in the valuation of that company. The internal, you may not know. You may know some external factors which are depicted on the reports, but you may not know a lot of other things that are going inside the company. So which is why it is best to invest in index. Index means it is going to grow over a long period of time, right? Regardless, whatever. So let's say if somebody tells you that, investing in an index is risky, what does that mean to you, right? To me, that means that don't we trust where the US market is going to be another 10 years down the line? Guys, I hear a lot of people ask me that, I don't trust the stock market. It sounds very risky to me. I'd rather invest my money in real estate because there is a house, there is a security that is there. To me, all that is BS. If you've done enough of your research, you will understand that investing in an index is not at all risky. It's very much possible to lose your money in individual stocks. That too, when you buy at a high and sell at a low. Let's say if it's a good company like Microsoft, Apple, and you still trust in the fundamentals of the company, you just have to stay put and then sell it, So it's a virtual loss. Until you sell the security, it's a virtual loss. But if you talk about index fund, right? So index fund, losing money in index fund in a long-term period just means that the economy itself is going down, which is not possible year over year. These companies are worked by hardworking employees like you and I, and they're working day in and day out to make the company go at a higher level. And believing that an index will come to a naught, right? It's stupidity. It's pure BS, right? It means that we don't understand the fundamentals of the economy, right? We are just saying that global economy will come to a naught, which is not possible. So guys, do educate yourself, but investing in an index, a diversified index over a long period, is the short way to grow your wealth. And once again, guys, if you have not subscribed to my channel, please consider subscribing and liking and sharing. So just to summarize this point, it's highly unlikely to lose money in an index fund given a long time horizon, a diversified index funds, and given that you do not take money out in a year or 2 year span, right? It's not an investment for a short term, it's a long term investment, guys. Understand the difference between trading and investment. When you are investing money, you are in for a long time period. So it's highly unlikely to lose your money there.